What if I told you that millions of Americans are already feeling poorer, even though salaries are rising? From the bustling streets of New York to the quiet suburbs of California, a shadow of uncertainty is stretching across the nation. Millions of Americans are grappling with the harsh realities of soaring debt, a housing market that feels increasingly out of reach, and a job market that's showing signs of strain. This has led many to ask a crucial question that could define the next few years. Is America heading toward another recession in 2026? To find the answer, we must look beyond the headlines and dive deep into the economic indicators that are shaping our future. One of the most persistent challenges is inflation. We've all felt its sting at the grocery store, the gas pump, and when paying our monthly bills. For months, prices on everyday goods have remained stubbornly high, eroding the purchasing power of families across the country. While the rate of increase has cooled from its peak, this persistent inflation means your dollar simply doesn't stretch as far as it used to. This sustained pressure on household budgets is a significant headwind for the economy, making it harder for people to save, invest, and spend. In response to this inflation, the Federal Reserve has been wielding its most powerful tool, interest rates. By hiking rates, the Fed aims to cool down the economy and bring prices under control. However, this medicine has serious side effects. Higher interest rates translate directly into more expensive mortgages, car loans, and credit card debt. For anyone looking to buy a home or finance a major purchase, the cost of borrowing has become a formidable barrier. This deliberate economic slowdown is a tightrope walk. Tip too far, and it could easily trigger a downturn. This brings us to the growing mountain of debt. As the cost of living outpaces wage growth, more Americans are relying on credit to make ends meet. Consumer debt, particularly from credit cards and auto loans, has surged to record levels. More concerning are the rising delinquency rates, indicating that a growing number of households are struggling to keep up with their payments. When people are buried under debt, they cut back on spending, which is the primary engine of the U.S. economy. This cycle of debt and reduced consumption can create a dangerous spiral, stifling growth and pushing the economy closer to a recession. Nowhere is this strain more visible than in the housing market. For years, sky-high prices and bidding wars were the norm. Today, the picture is different. While prices remain elevated, the combination of high mortgage rates and affordability issues has sidelined many potential buyers. The market is slowing down, with sales volumes dropping and inventory sitting longer. A significant contraction in the housing market has historically been a reliable predictor of broader economic trouble, and the current cooling trend is raising red flags for many economists. Finally, we turn to the labor market, which has been a surprising source of strength. Job growth has remained resilient, and unemployment has stayed near historic lows. This has been the main argument for those who believe we can achieve a soft landing, taming inflation without causing a recession. However, cracks are beginning to appear. We're seeing an increase in layoff announcements in certain sectors, and wage growth, while present, is struggling to keep up with the cost of living. If this positive trend in the job market reverses and unemployment begins to rise, the last pillar supporting the economy could start to crumble. When we piece these indicators together, a complex and uncertain picture emerges. Economic models offer a range of probabilities, but none can predict the future with certainty, especially with global conflicts and political instability adding to the volatility. The path to 2026 is fraught with risk. While a full-blown recession is not guaranteed, the warning signs are clear and growing louder. As we navigate the coming months, the key will be to watch these trends closely, because understanding the challenges ahead is the first step toward preparing for whatever the economic future may hold.